So you've got a deal, but you want to know how to structure with investors so you can actually raise capital? Let's dive on in. So whether you're new to real estate or you've been doing your own deals, at some point, the only way to scale is to start bringing on investor capital. And the first question that's going to come to your mind is, how do I actually structure deals with investors? What the hell do investors actually want, right? Because you've got to structure it in a way that not only works for you as the operator of the project, but you've got to make it so that investors actually want to give you money so you don't struggle to raise the capital to do that deal. Well, the first thing to know before even diving into how to actually structure it with your investors, what terms to give them, you got to understand that there are several different legal structures by which you can actually raise this capital. All right, let's get into sport mode. So you can structure it as a partnership, as a syndication, as a joint venture, and there are pros and cons to each of these different investment structures. The majority of our projects are syndications, where we use LLCs as the legal entity that owns it. But you could also own a property in an LLC with partners that is not a syndication. The biggest thing there is to talk to your attorneys, talk to your CPA, and figure out what is going to make the most sense for you and your tax structure. Now, I've structured deals in many different ways, and so today I'm going to show you the different projects that we've done, how we structured those deals, and why we would or wouldn't do that again on the next go round. Now, the best way in my experience to structure these deals is through what's called a 506B syndication. That means that your investors are silent partners in the deal. You get to make all of the day-to-day decisions, but they have to approve that on the front end. You can raise capital from up to 35 non-accredited investors and an unlimited amount of accredited investors. One of the downsides of that is that you can't openly market it. Now, the reason that you're not allowed to just openly market a project like this is because you are taking capital from limited partners, which means they do not have an active role in the day-to-day of the legal entity that you're buying the real estate in. And if you are taking capital from limited partners, that is governed by the Securities and Exchange Commission, the SEC. So they make all the rules and all the guidelines, and you definitely don't want to mess with them at all. So this building behind me is a 28,000 square foot office building. It was actually one of my earliest deals that I did back in 2019. And this was a traditional partnership. So the current owners already had an LLC with their partners in it, and they were mostly hotel guys. So they brought me in as the turnaround developer. So I came in, negotiated a minority equity stake of about 7.5% with no money out of my pocket in exchange for taking this building from 40% occupancy to now 97% occupied today. One thing to note about that, you don't actually have to go acquire other properties. If you have the operational experience and you can come in and bring a significant amount of value to an already existing project, you can negotiate with the owners to just come in and help them turn it around without actually any money out of pocket. Now, we've done some videos before on how to do commercial real estate deals with little to no money out of your pocket. Check out this video here to dive further into that. So we bought this 48-room motel through a 506B syndication, which I was telling you about earlier, and raised about $4 million in limited partner capital for this project through about 50 different investors. So syndications are very similar to what you see on Shark Tank, where I'm going to sell you X% of my company for Y amount of dollars. So we sold 50% of the equity in this project to the investors for the dollars. They're going to get a % preferred return, and we're estimating about a % internal rate of return with close to a X equity multiple on this project. While I've got you, I'll give you a little preview of Salt Ranch. This is a roadside motel that we're transforming into a boutique hotel here in Nashville. This is the main house that was built in the 1800s. We're standing right next to where the bar and the restaurant will be. The pool will be right outside, and it'll be this nice little retreat where Palm Springs meets Southern hospitality here in Nashville. Now, the JV that we're working on is still in contract negotiation, so I won't be able to show that one to you yet, but I'm going to give you an overview of how we're planning to structure it, because I have done deals like this in the past. The owner owns the land outright. They've had it for generations. They don't have any debt on it. They don't really want to take a big tax hit from a sale. So we're having them contribute that land into a joint venture as their equity, and we're going to get it appraised and determine the total project cost. Let's say the land is worth $1 million, total project cost is $10 million. We're going to give them 10% equity in the project, and my partners and I will come in and take on all of the debt and actually make the development happen. So that's another way to get pretty creative to where you don't have to come out of pocket too much. You can actually partner with the existing owners of the property instead of having to go through a brand new acquisition. Saves you a lot of money, and it also makes that property owner significantly more money in the long run. Based on our conversations right now and where we think the project is gonna go, we're probably gonna double or triple their existing capital in about 5 years. So as you can tell, there are so many different ways to actually structure the terms with your investors. But at the end of the day, it comes down to what the investors actually want in order to make a deal happen. Your investors could be completely different from my investors, and they may want entirely different terms. Let's go through a wide range of what investors typically like to see in these deals. Okay, so first up is the equity structure, the meat of the deal. More often than not, I see the investors selling off between 70 and 80% of the equity in the project, which means they're keeping somewhere between 20 and 30% to make these deals happen. But it depends on the deal. For example, as I talked about with the hotel, we sold off only 60%. Well, that's because our investor returns, despite only selling 60%, were still higher than our typical deal size. And so the investors were totally fine with that. We also, as the operators, have to start and open a hotel, which is a much more intensive operation than a value-add multifamily deal. The other thing that I'll note is that it depends on the type of asset that you're investing in. Multifamily, for example, might see 8% preferred returns with a 12% IRR and the investors owning 80% of the partnership. On the other hand, with development deals, you might see an 8 to 9% preferred return, a 20 to 25% plus IRR, and a 50-50 equity split since it's a much riskier venture. Now let's talk about preferred returns. A preferred return is the amount of money that you have to make your investor before you can participate in the equity splits. So let's say you've got an investor with $100,000 and you've got an 8% preferred return. Well, year one, you have to make them at least $8,000 on their money before you can start to see any portion of that 80-20 or 70-30 split. A lot of investors like to have this because it shows that you have skin in the game to make sure that they are making money before you get to really profit from the deal, which means that your views are very much aligned. So how do you actually structure your deals with investors? Well, I'll show you how I structure mine, and feel free to copy this playbook because we've raised well over $20 million worth of equity in the last 4 years using this strategy. So what our structure looks like is very simple, which is the best way to do it for your investors, because if you confuse, you lose, and you want to make sure that you're actually raising that capital. So we'll do a 70-30 to 80-20 equity split with a 6% to 8% preferred return over a 5-year time horizon. That's pretty much it. That's how we do almost every single one of our deals. The targeted IRR for our value add projects, which is not as intense, is anywhere from 17 to 19%. We typically aim for that 18% range. If we're doing more of a development or something that's very heavy value add, we'll go for more of 22% to 25% plus on the IRR. And both of those will typically end up in the 2 times to 3 times equity multiple range. At the end of the day though, it all comes down to what your investors are comfortable with, and keep in mind the different market fluctuations. We used to have a 6% preferred return back in 2020, 2021 when interest rates were relatively low. Now that investors can actually just invest in treasury bonds and get 4% plus, 6% isn't as exciting to them, so we had to raise that to 8%. Keep that in mind whenever you're structuring your deals, and always put the investors first. I know it may seem tempting to look at a deal and go, oh, the returns are way too high, I can't give that much to my investors, but those investors could become lifetime capital for you. So there you have it for how to structure your real estate deals with investors. You want to take a deeper dive into syndications and how they work? Check out this video here.